tutorial with Kukura Capital. Now in this video tutorial we're going to be discussing how to make money in the Forex market. Now in our previous video tutorial we briefly discussed that in the Forex market you're able to make profits off of small fluctuations in the Forex market. In addition to that, we're fortunate enough to make a huge fortune off of the market regardless to whether it goes up or down, and I'll be discussing this in more detail in this video tutorial. Now the small movements in the Forex market we refer to as pip movements. Now pips are the most important unit in the Forex market. Now the main reason for this is how most traders calculate their profit and loss, and also how they balance their risk and reward to make sure that they have good management around their risk and are not too exposed in certain trades. Now what we have is, okay, pip in general stands for percentage in price, but that's not really important. Now what you need to understand is how to calculate a pip and what a pip actually is. Now once again we're using the same example from the previous video tutorial that we had, and that's the Great British Pound and US dollar. Now in this example we have that for me to buy Great British Pounds in US dollars is going to cost me 1.6567 US dollars. So you need to understand what that means, and we will be discussing how to read a currency pair. Now in this example you can see the pip position is normally and usually the fourth decimal place in your exchange rate, and here it's 7. So in the instance that this exchange rate increases to 1.6580, then we've increased by 30 pips. In the instance that it goes to 1.6560, we've decreased by 7 pips. So it's really basic, and it's really important and fundamental and critical to successful trading that you are able to understand how to calculate pip movements. So if you want to be successful and make sure that you understand how to calculate a pip, do visit our website, go to the presentations tab, and you see that we have quizzes after our presentations that test you on the material that we've taught you, and one of the things that we have there is a quiz on how to calculate pips, so you can make sure that you're successful and understand how pips are actually calculated. So what we have here is now when you're actually trading, how to deduce how much each pip is valued at. Now one single pip can represent 10,000 rand, 100,000 rand, 10 cents, literally any range across the board. So what that means is that if you move 2 pips and you've traded at 10,000 rand per pip, you get 20,000 rand profit. In the instance that you move minus 2 pips, then you get minus 20,000 in your account. So why a lot of retail traders, a retail trader is basically someone who trades at home in their personal capacity, opposed to someone who trades through an institution such as a bank, are unable to be successful with an 85% fail rate in retail trading, is because of the greed. Now what happens is a lot of people tend to think, oh, if I can trade at 500 rand a pip and 2 pip movements, I'll make 1,000 rand and all of this stuff. But obviously the same happens if it goes against you, and more often retail traders don't really do a critical analysis of when they enter trade. They just enter with high hopes of making a profit, and that's not actually trading successfully. So you do need to be able to effectively manage risk, and that we'll be discussing in another video tutorial. So the value at which a pip represents, it depends on the volume at which you trade. Now if you trade a very small volume, like at 0.01, you're trading about 10 cents per pip. So if you move by 1 pip, that's about 20 cents. But it's a bit more than that, because within 50 pips at 0.1 you can make over 100 rand. So it depends on the volume in which you trade, how much each pip will represent. So obviously when you start, you want to start at a very reasonable small amount to reduce your risk and exposure. Now the next thing I want to discuss is that in the Forex market you're able to make money regardless to whether you have an uptrend, which is also known as a bullish trend. You're able to make money, and in uptrends you take long positions, which are also called buy positions. Now what happens is you have what we call the bulls, and they push the price up, and that's what gives the momentum for an uptrend. Now alternatively, you can have a bearish trend, which is also known as a downtrend, where you have the bears who push the trend down. Now this concept is absolutely important, because the bulls and the bears are constantly fighting for their own agenda to be won and displayed in the Forex market. So what happens usually is that you have your bulls at the support level and you have your bears at the resistance level, but don't worry too much about that. We'll be explaining this in more detail as we do our support and resistance video tutorial. But it's really important that you understand, especially when we do our masterclass tutorials where we discuss candlestick analysis, you really need to be able to understand what's just happening in the market, because a candle can basically tell you who's dominating the market. So obviously if you're in a bull dominated market, you want to be taking long positions, buys, which means you're buying hoping for the price to increase, knowing that they're going to push the price up. And obviously if you're in a bearish market, you want to be taking a sell position. Now a sell position is more complicated, and we'll be discussing it in a separate video tutorial. But when you're a beginner, the fundamental rule is that the trend is your friend. You don't want to trade against the trend. So if you're in an uptrend, you want to place a buy. If you're in a downtrend, you want to place a sell. You don't want to be doing a counter narrative situation where you're in an uptrend and you're placing a sell. That's not how you're going to be profitable and successful in trading. Now, as I mentioned, in a buy uptrend, you place a buy. So in a bullish trend, you place a buy. Bullish is also known as uptrend, so the B for bear. And in a bearish or downtrend, you place a sell position. And you can see I just inserted the buttons here, but we'll be discussing this in more detail as we do a separate video tutorial just on discussing how to place an order. Now the next thing is you need to be able to successfully read currency pairs if you want to be successful in forex trading, because obviously that's the fundamental crux of forex trading. You're trading currency, so you need to be able to successfully read the pair. So what we have in this example is our Great British Pound and our US dollar at the exchange rate of 1.6567. So in essence, you have the base and the quote, because you always have two currencies paired together because you're simultaneously buying and selling currencies. So in the instance that we believe our base currency, which in this example is the Great British Pound, is strong and is going to do well against the dollar, we would place a buy position. So let's say you got an economic release that was really good, or you got some good news or something great was happening in the UK and you expect that it's going to make the pound strong, you would place a buy. And don't worry too much about these things about economic releases, because I will be showing you everything you need to know about that in a separate video tutorial. Now in the instance that you believe that the base currency was going to be weak against your quote currency, so for example just based off a Brexit news that you knew, okay, Brexit is going to happen, this is not great for the pound, you would know that the pound's going to be weak and you definitely place a sell, because you know it's going to be weak against your dollar and therefore it's going to go down. So I'll be explaining this in more detail when we do fundamental analysis, but the crux of it is when you believe your base is going to be stronger than your quote currency, you place a buy, and when you believe your base currency is going to be weaker than your quote currency, you place a sell. So to summarize, we will be doing a practical application of how to place an order, which is the fundamental instrument in order to make money in the forex industry. If you can't place an order, then you're not even trading. We'll be doing a separate video tutorial on this, and we'll be discussing the concept of sell in more detail, because the concept of buy is pretty straightforward. You expect the price to increase, while selling is a bit more complicated, and we'll be explaining that separately. We hope you enjoy the video tutorial. Please make sure that if you want to keep learning with Kukura Capital, that you like and subscribe our videos, and then you go and visit our website www.kukuracapital.co.za to get more resources that help you become financially successful. Thank you for watching.